Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. Today I review the FDIC Quarterly Banking Profile for the second quarter of 2008, released yesterday. My first blip explains my opinion that the FDIC Quarterly Banking Profile is the balance sheet of the U.S. economy. Total assets declined by $68.6 billion to $13.3 trillion, which is a decline of only 0.5% sequentially. This is the first decline during the Great Credit Crunch, and it warns that problems are just starting to drag the broader economy. This will cut into the $14 trillion U.S. economy in the quarters ahead. When you see net income decline 86.5% year over year to just $5 billion, that's quite a drag. What would happen to a company's stock if net income dropped by this percentage magnitude? I compare the Great Credit Crunch to the FDIC asset contraction of 1988 to 1992, when total assets declined 4.2% in the 16 quarters between Q4 1988 and Q4 1992. During that period, Q4 1990 and Q1 1991 were 2 consecutive quarters of negative GDP growth. This cycle will be worse. The alphabet soup of new types of loan exposures did not exist 20 years ago. My second blip reviews the background behind my keen interest in the FDIC data. I have been studying the FDIC quarterly banking profiles since March 2006 and published my first of many warnings in April 2006. At that time, I predicted the problems that are beginning to cascade today. My main concern, away from mortgage defaults and home foreclosures, continues to be construction and development loans. After all, I correctly timed the top for the home builders in June 2005. C&D loans declined by $5.4 billion in the second quarter to $625 billion. The chart shows rising trend in loan defaults in this category. The home builders continue to have trouble reducing inventories, so how are they going to repay C&D loans? During the 1988 to 1992 cycle, C&D loans declined 54.7% to $98.1 billion from $216.6 billion. My third blip looks at the rising trend in list of problem banks. The list of troubled banks grew to 117 in the second quarter, up from 90 in Q1. Sources say that the list has grown to around 140 since the end of June. Assets among the 117 are $78.3 billion, up from $23.6 billion. More important is the fact that the net charge-off rate rose to its highest level since 1991 in the midst of that 1988 to 1992 FDIC asset contraction. Net charge-offs totaled $26.4 billion, almost triple the $8.9 billion of the second quarter of 2007. My fourth blip indicates that loan loss provisions should continue to rise. The coverage ratio should be increased, even though reserve for losses were up to $144.3 billion, up 19.1% sequentially and 77.6% year over year. Compare this to the 30 to 89-day past due loans of $111.9 billion, up 51.1%, non-current loans of $162.9 billion, up 140.7%, and other real estate owned of $18.9 billion, up 136% year over year. Other problem categories continue to rise. Non-farm, non-residential loans up 10.3% year over year to just above $1 trillion, and home equity loans up 12.2% year over year to $647 billion. The alphabet soup of notional amount of credit derivatives is up 18.4% year over year to $183 trillion. Just beware that the Great Credit Crunch could last into 2012, the year 2012. If you have any questions or comments, shoot me an email, gmcreports@aol.com. That's today's 4 in 4. Enjoy your day.